Hi guys, I trust you are all well. Let's just put up our charts and get cracking. Hope everyone is fine and that you've had a pretty decent week in trading and that so far everything's looking up well for you. Now, I'm quite excited by what I'm seeing in the markets. But what I want to do is just try and remain consistent in terms of what I'm showing you. So let's start off by having a quick look on what's happening on the daily charts. And I want to show you a couple of other things here. So we've been speaking about this for quite a few weeks now. We spoke about the resistance at the top when we're getting there, when I said, the strong level of resistance here. At that point, when I was emphasizing that, we only had this low, and we spoke about the possibility of us going into a trading range, and now we are exactly at the spot where the market might want to, or the market is testing that low. If bulls are strong, we'll get a double bottom here, so today might end up as a reversal day, or it might be tomorrow. If the bulls are strong, we'll have a double bottom. So I mean, have a look at kind of where we've come from, and everything that we've spoken about. And if we kind of using price action as a predictive measure of where the market is going, and I think we've been spot on. Remember, I always say, as a price action trader, when you think things are clear, always tell yourself 60% chance. So 60% of what the probabilities of what you've spoken about is what the market is showing us, which makes just region of price action pretty exciting, if you use that way to trade. So let's not dwell too much on it because we have spoken about it before. But what I want to point out for you is you always have to be constantly drawing measured moves in the market. So, we had the measure moves here, and we kind of said if we broke beneath this, market wants to get to that level, we measure we're there when we put that in the market with false breakouts, etc. But we reached that target, okay? Now we have this reversal pattern here inside, that's a trading range of sorts. If the market breaks beneath that, that's a goal where the market would like to get to. But we're not forgetting this level of support. The reason we do that is if you're in trades, you're going to decide whether to take your profits or take partial profits and wait till you get to that level. There's a pretty strong level of resistance coming up here. Okay, so we're pretty clear about what's happening on the euro. Let's have a look on the gold daily, just for us to keep painting this high level picture. I added in a few more things for you to have a look at. And again, same kind of things that we mentioned. Remember, in one of the, can't remember when now, months ago, when we were talking about support, resistance, and where to draw your lines, and we said if you see a huge tail on any time frame, markets are fractal, so patterns that we see here can repeat themselves, will repeat themselves on other time frames. But if you see a huge tail, or if you're drawing any lines of support and resistance, you can always just plonk in your line chart, okay? And your line chart is drawn on closes, and closes are very important. Where did the day close? Where did the week close? Where did the last 5-minute candle close? Where did the last hour close? So all of those are very important. So if we were to do that quickly, just to get a sense of, hey, hang on a second, I had this huge tail here. What does it mean? Okay, I mean, we know at some point in that particular day, the bears had full control of that, and the bears would have loved the market to close down there to show strength. That would have been a beautiful breakout and follow through, but that didn't happen. We're buying back into the close. They kind of closed back more than 50% of that range at that particular moment, inside candle, etc. But you kind of say, well, what should I be watching out for? So you can see that's why you plonk it in very quickly and just kind of say, oh, okay, so that's a key level. The market may want to bounce off that at some point. So the market is seeing that. Okay, I just got to take this off my thing. That's for my secretary. Okay. All right. Okay. Now, here's what we spoke about that. We said at that point, that leg one pullback, leg two was for that bear breakout beneath the moving average, strong breakout follow through. So that's what we're marking with this particular measured move, that first breakout and pullback, and the pullback was there. That's our pullback. There was a resumption. So that's a pullback that we watched. If you talk in price action terminology, that's a low one. So if you wanted to jump into the market at that stage, at the low one, put your entry beneath that, your stop above that, and you are anticipating that the trend will resume again, and then you'll have an extension, leg one pullback, leg two. So if you had done that on this time frame, you could have taken your profit here, made an easy 100% return on whatever you've invested with the stop up there. But then also we had the measured move. There's a breakout of it, measured move. So pretty level, strong level of support there. So when you see all of that, there is no surprise. Okay. When you see that, there ought not to be a surprise because of what's taking place here. But you still have your bear case. I don't think we put a trend line at that point, but let's just put it in for illustration purposes. So at that point, you took the trade, you expect an acceleration that failed, you had an outside candle. Remember, I said we don't get out of the trade because that's just a huge trading range. The assumption is there'll be sellers above here because you sell at the top of the trading range. So you hold on to your trade. That's why you don't just put a stop where you think is safe. You put your stop in the correct technical level. If you can't put a stop up there, don't take the trade. Wait for something that you can trade. Inside candle, perfect. So you would have taken a trade there, and the goal is the same goal as here. Okay, the goal for taking that trade, same goal as here, and that's where you want to get to take your trades. But because you think, hang on, I might get a further test down here. If you don't take profits, or you've taken partial profits, whatever the case may be, you now have a bear trend line, okay, 2 touches. So if market comes back to there again, you can look to take a trade. So if you'd seen that, you'd again taken the trade now at that particular point, if you'd taken that, okay, because this level has already been reached. The market has achieved its goal, okay. Now at that particular point, you say, hang on a second, if I take that, where do I place my profits? Now, where do I take my profits? Okay, 2 areas. If you want to take optimal profits, that pullback, that high, that low, that pullback, that is a trading range that if we break beneath that, there might be a measured move. So from that high to that low, there's a measured move down there, okay? And that's all you would have at that particular point, okay, this particular one. But then also you have this huge breakout. Okay, so there's a breakout that's taken place. I need to move this so that it's not cluttered. There's a breakout that's taken place. There's a pullback. The moment we have market pulling back and then a resumption, that's what we call a low one. So we expect some trend resumption. It didn't resume. But your leg one, pullback, leg two will be saying, okay, that's probably when I take profits. So that corresponds, that first leg, pullback, second leg corresponds to this measured move, this low, that high. If we break beneath that, that's how far we go. That's where you should hold out, okay, and try and optimize the profits, whether you trade in longer time frame to take you a few days to get the 60% chance. I'm 100% certain 60% of the times. That's when the patterns are when the strategy is set up. I'm 100% certain 60% of the times. Okay. Now, if you wanted to take early profits and you kind of say, hey, my mindset does not allow me I can't sit through pullbacks. If that's where we're likely to go, I've seen this tail. That there may be buyers down here. It's just too agonizing. Rather take my early profits, wait for another setup. Where would you aim to take your profits? Well, this is where you'd aim to take a profit. Just again, use measured moves and you see how it makes sense. So that's your signal bar, they're bouncing off that. Okay, so you say, okay, I'll just take a measured move of that signal candle. There's a measured move, but your stop is not there, right? Your stop is there. Your stop always got to go there. When you break beneath this and pull back, that's where you put your stops. So you take that trade and you're aiming to get to that level. That alone is 1-to-1, but because your stop is up there, so it's probably 0.75, whatever, which is fine. You know, you just keep on doing that, you know, and just bank your profits. That's if your psychology does not allow you to sit through a trade. Okay, but if you're waiting and if you're able to sit through, which you must train yourself to do, that's why we're in this business. That's part of how we make money and optimize the profits that we make in the market. But then what do we get? We get a beautiful entry candle. That's a breakout beneath that. So that's a low one, first low after the pullback. There's a second low. Low 2 entry is fantastic. You might get 2 legs after that. That's leg 1, pullback, leg 2. So beautiful entry bar for the bears. Excited with that. Then we get a pullback. No, nothing to worry about. We still have the 10 moving average, which is our indicator of strength, of breakout strength. Beautiful coffee, this. At that stage, okay, so there's your trend line. I'm going to leave it here, so we'll come back in future days, weeks, and see if the market still respects that. But you get that breakout, get a pullback back to this. So now what do you have? Now you have a leg 1, another leg 1, pullback. Okay, so that's where I put that. There's the first leg, and in there's a pullback. So again, with that, you kind of saying, okay, that's now I have 3 potential levels of support where I can take profits. Okay, so I'm just gonna hold on to my trade. Now, if you're holding on to your trade and if your psychology is messing you up, at that stage, you've had the breakout and the pullback. You can pull down your stop to above here. Okay, so you kind of reduce the risk. It's not yet at break even. When you get this breakout candle, now I'm talking about, you know, you manage your psychology, learning how to hold on to trades. At that stage, you can pull your stop to break even. That's perfectly fine. Then maybe you can relax and just wait to see if the market gets here. So let's wait and see what we get today. Still early days yet. We're still only halfway, you know, early hours of the London European session. There's still the US session to come. Let's see what happens there. And, you know, then we got Thursday, we got Friday, we might get there. We might pull back, but we still have the descent and trend line. So if you put your stop at break even because of these breakouts beneath previous lows, then you can just wait. Alternatively, manage your trades. Wait and see. Okay, so that's what's happening gold at a macro level. Now, S&P 500. That's the largest 500 companies publicly traded in the US big economy. So you're participating in the US market. So beautiful. You know, this is a good one to look at. Now, I'm not sure if I mentioned the reason that this could be pretty useful, depending where you are time zone wise. If you find that because of work and commitments, well, sleeping, you can't get to the Asian session because you got to rest. The European session, when it's taking place, maybe at work, and you kind of say, well, you know, I come back, I see all these moves, and my work does not allow me to actually participate in trade. How, you know, it's 24/7 market. What do I trade? Well, you can still trade currencies. You know, I've got the euro versus the dollar, major. Told you why I chose that. I've got gold in there. You know, or you can now say, okay, now I know the US markets opens towards the afternoon, the middle part of my day, you know, if you're in this kind of time zone. So even if I get home, I've missed the first hour, the first 2, that's fantastic. I can come and still trade actively in the market for another 5-6 hours. So you don't, the chances of you have a greater chance of decent price action for you to trade and make money. Whereas sometimes with currencies, after the London session is closed and another hour after that, you know, the range tends to decrease, and you don't want to be in a market where there isn't enough range. And when I'm trading the 5-minute time frame, for me, I want to be trading the market where there's like a 20 pip range at least. If it reduces, you know, I don't want to be in that market. You can trade it, of course, if you know how to scalp it. Fantastic. So S&P 500 is a very good one to look at, and there's calculators and everything that can help you work out your risk sizing. But for now, so that's, you know, so those are the three markets that I'm trading. So I've put it up here for you, so we can see. But good things, interesting things are happening. We spoke about it, so just for a couple of seconds. I mean, just have a look at that. This is a daily time frame. I mean, right from February 2020, okay, and into this whole COVID situation that has just been in a massive bull trend, you know, trading ranges, but it's just carried on, and we can analyze that and look at it, etc. Where we are now, which we spoke about before, this massive trading range that occurred there, we are at a measured move, close to the measured move of that. Okay, and that's where we're getting that profit taking based on initiate a reversal. All of those things are happening. We also have, for the first time, I mean, you could extend this all the way back in that period. We have a decent break beneath that trend line. So as far as we are concerned with the strategies that I've been talking about, we are in a major trend reversal alert. Very key. It's an alert that this amazing bull trend may now just be about to reverse, but it's just an alert. Okay, why is it just an alert? Because from a bull trend, from any trend, market tends to enter into a trading range. Okay, so while I'm thinking, hang on a second, major trend reversal alert, ingredients are in place, break off a trend line. The market tested that low. I'm waiting to see if there's a lower high. You know, we get a lower high here, double top lower high. Waiting to see if we get there and trend resumption, etc. We are in a trading range, and if it's in a trading range, you have to trade it as a trading range, while you're keeping at the back of your mind that one of these entries, you know, may. So if we get up here and with a double top and the lower high, or even that lower high, one of these entries, there is a chance, if the bears are strong, that we might just get a continued breakout down here. But if the bulls are strong, bulls know there has to be profit taking. You know, we have to enter into a trading range where the bulls can always come back into the market double bottom, higher low, another higher low, and resume the trend again. But you're not going to get caught by surprise, right? Because you're in a trading range, which means you are buying in the lower third of the trading range once you have this double bottom. So now, you know, you wait for your setup, or if you get a double top here, you look for your setup in the middle third. Your stops always up there or down there, whatever the case may be. That's if this is a chart that has appeared before you. Okay, so here's where we're at with S&P 500. What are the possibilities at the present moment? Leg one, pullback, leg two. So that double bottom here has completed this pattern, the measured move of the breakout, leg one, leg two. So this particular pattern is complete, right? So we're going to look at what else is forming in front of us. There is a double bottom. The double bottom is fantastic because it says to you, if you are a bear, you're saying, okay, if the market breaks beneath that, this is where I want to go. So if I want to go there, I will have taken out that low completely. Of course, And if I close down here, I've closed beneath that close, so I'm showing that the bulls, that the bears are strong. Okay. If you're a bull, you're saying, okay, profit taken, trading range. I'm going to wait for my setup. If I get my setup, I do know that if we break out above the trading range, so the bull is saying, well, if we break out above the trading range, that's where we want to go. That's our measured move. We want to take the market, 4.7, that area, 4,700. Those are all possible. That's what's going through traders' minds, computers. That's what's happening. Then we have the pullback. We have a double top, lower high, double top. Okay, and at that particular point, before you see that, you kind of say, well, if I take that trade, if I put my stop up here, that's the correct place to put the stop. What am I expecting? Well, I'm anticipating, if I take that trade, that if we have a break beneath here, that's to the extent that I'm going to go. Fantastic, kind of corresponds with that level. That's if you're there, prepared to put your stop above there. If it turns and I start to get a reversal and that top is taken out, well, my stop is up there. I can close my trade. Maybe I've just lost 1/3 of the risk. No big deal. I'm managing my risk the way I ought to manage it. If you are a bull, the way that we trade, okay, we've seen the double bottom. Now we need a bit of separation. We want to see a higher low for us to look the trade. With that kind of setup for the bears, you're not going to jump into that trade at a particular moment. You want to see bullish breakout resumption, higher low, or a close above moving average. Now, something interesting happened, which I want to have a look at. I keep talking about this, that if you, I've been trading price action 12 years, 10,000 hours, lost tons of money, got the experience, worked on my psychology, and I can wait for setups to come. If you train yourself to do that, you will also get there pretty quickly. So some things that you start to pick up. The reason we keep popping up the daily, it's not just to just get a sense of what's happening with the market. Okay, or say, I know what's happening with S&P 500, gold, euro. But it's for us to get a sense of what could be happening in the lower time frames. And I've always said, I hate to use the word bias because that can block you and cause you to miss trades or lose money unnecessarily. But if we use that for the sake of simple illustration, hold on to your bias like an egg. Okay, so you have a look and say, okay, this is what may happen. There is this level of probability that this may happen. For us trading the daily time frame, this is what is likely to happen. I'm 100% certain that 60% of the times this might happen. So that's holding it lightly. I'm not saying, oh my goodness, I've seen it. It's 90%. I'm just going, this is my bias. That's a very dangerous place to get to. So once you've seen, you've seen all of that, major trend reversal, all of the stuff we've been talking about, and you see that double top, lower high, you see where the bears want to take the market, all of that, and you see that particular signal. If you're trading the daily, you look at that. Then that day, the next day, man, if you don't go to work during the Asian session, if you go later, you got to get up early that day and see if you're able to get in, if anything sets up for you to take a trade. And once you set that up, you can set your take profits on the extension of the day's range. So you could say, okay, I found a way to put the trade. At the very least, if that triggers, I'm 100% certain that 60% of the times, if it triggers, the market will seek to extend to the range of yesterday. So I can set my take profits there and go to work and come back and see what's happened. Profit, stop up there. So it's, half the risk, half the return, so 0.5%, which is still fantastic, more than the banks would give you. Okay. So when you see that kind of setup, 60% chance, go into the day and have a look at now. How do you look at the day? Everything we've been speaking about. Okay. So let's drill in and let me show you what happened and the opportunities that would have been here for, I mean, whichever way you work it out. If you trade the strategies, this is my trend strategy that's set up. And it's a classic example of how it's set up and how you can come into the market anytime during the day and be able to extract your profits if you were able to trade the whole day and take an appropriate break and whatever. 12 hours in front of your chart, you would have made a ton of money. You don't have to trade again that whole week, even that whole month. When this set up, you must take it. So let's have a look at this. So this is a previous day. This is this day. This is that day, that setup. Okay. So when you come in and we do our daily setup, which we've spoken about over and over and over again. So you're coming into this day. Excuse me. You're coming into this day. We plonk in low of yesterday, high of yesterday. That's standard. We always do that. Purple line, magenta line, horizontal, the open of the day. Okay, minimum stuff that you do. Now, a little bit of advanced trading stuff that we're going to add on to what we've been discussing, but easy stuff. There's nothing complex about it. You just have to do it a few times, then it's like, oh, it's all over the place. There is the range of the day. If let's start off on the opposite side. If the bulls break above the high of yesterday, okay, so you're marking that there. The expectation is to get to a measured move because it's a trading range. Remember, we always said, whenever I see a trading range, do a measured move, right? So we've been looking at trading ranges within the day. But yesterday's range is a trading range. So if the market breaks above that, the target, the aspirations, the goal is to get to a measured move, which if the bulls are broken above that, okay, that's a measured move where they want to go. Okay. If the bears break beneath this, the measured move of yesterday's range is down here. That's where they want to go. Okay. So you put your measured moves in. I hate clutter. So I'm going to take this one out. And the reason I'm taking it out is I would have taken it out at some point here. Okay, because I would have seen another key marker, 50% pullback. Remember, when we are speaking about breakouts, especially surprise breakouts or news breakouts, I say I prefer, I want to be out of the market. I don't want to be setting an entry before the news unless I've been in for a couple of hours and then sitting there, biting my nails, trying to guess where the market's going to go. Then the market starts to move and you get confused. You don't need to do that. Okay. What I prefer to do is, if I'm not in the market, and I've given you all the rules around that, is wait for the breakout, wait for that news breakout to close, wait for the follow through, the next candle, see if there's follow through, because I want to measure the full extent of the breakout. Then I want to look at the 50% pullback, because if the bulls or the bears that have created the breakout are strong, we are going to defend the 50% pullback, because if you give away more than half your position, you're weak. Okay, then the other side now has a chance to capitalize on it. So you always ought to mark, okay? 50% pullback of yesterday's range. So that's there. Because if we get over that, take it off, delete it, okay. The bears were not able to defend 50% of the range that was created yesterday, or vice versa. If market is pulling back and the bulls will fail to do that. So I have my 50% pullback in there. Now, there is the open of the day. There is a 50% pullback. Now you are in the market and you're saying, okay, I need to find ways to get in the market. I don't know yet how it's going to unfold, but I know I had this beautiful bear reversal signal candle that the bears who are trading over the time frame are looking at, and they want to jump into the market. So 60% chance that it's going to be a bear day. I've got my 50% pullback. I've got to find ways to get in the market if it sets up for me. Market opens up and you guys say, oh, fantastic, bear breakout, but it bounces right off. This is the low of yesterday. So nothing for you to do. We come back to the high of the day, and again, we have a failed breakout above that high of the day. So now we have a trading range of sorts that's been created at this particular stage. And you've got to try and find ways for you to jump into the market. Now, so that's a double top higher low. We have a low here. Okay, failed breakout beneath that pattern. It's a low, but I'm not seeing any way to jump into the market. I want clear separation. Remember, let's talk about at least 6 candles. I have some middle of the forming trading range price action. Nothing for me to jump in there at the particular moment. If you wanted to, you could put an entry above that. 3, 6, almost 6 candles, but your stop has to be there, and you're aiming to get to that bottom. But I wouldn't at that stage, because it looks like price action. I mean, just open your eyes in price actions, or price action, sideways price action. So there's a trading range that's formed here. Another trading range that's formed here. So though we have a setup, it's within the middle of a trading range, which is also the middle of this forming trading range. So just wait. We don't have to jump into stuff that is not clear. Then we get to this magnet that's pulling the market down, the low of yesterday. We failed to break here. Now here's another attempt with that bull candle. At that particular time, it looks like, oh, a double bottom might be forming and the bulls might be reversing all of this. But we have an immediate follow-through bear candle. Bears are strong, but we have a tail at the bottom. We have a doji that's been formed. Okay, good for the bears, but if the bears are strong, why can't they give me a couple of strong bear candles? Just confirm the move. Okay, like we got here. Bear breakout, follow through. Then you can say, okay, bear breakout, follow through. Let me look for pullback to trade. So when you see that, don't forget what's on the left. Okay, there's information being provided here. This is where you just have to wait. You've got to you have to train yourself to wait. If you're 100% certain 60% of the time for your strategies only works when they're set up in front of you. Not when you think they're set up, not when you kind of say, oh, maybe today, it might just work. Then your probabilities are way off. That messes up with your account, messes up with your psychology, and you don't have to pay the school fees that some of us paid. That's just keep that in mind. Okay, so nothing for us to trade here because nothing on the left is saying to us we must trade. But having said that, we have broken beneath the low, we've bounced off it. So good for the bears. Let's see if we get breakout follow through for me to trade. We don't get that. Instead, what we get is a bull resumption. So now, while I had here, a double top. I don't know what I said. How about I didn't say higher low, but higher high double top. Down here, I have a lower low double bottom. Okay, so it's a form of a trading range. I have a double top, double bottom. It's not equal. They're not always equal, but I see a trading range, and that says to me it's a breakout mode. Whenever you see a trading range, it's breakout mode. The market will break out at some point, and when the market breaks out at some point, all these little rules play in your mind. That 50% of breakouts fail, which means I have to actually see the breakout. I have to see the follow through for me to say confirm breakout. Now, let me look for my pullback trade. So you'll notice that I use my eyes quite a bit. So you could put all of this in and say, well, let's see what breaks. I mean, until you trained yourself, okay? But I also don't like clutter. So you can put it in, delete it, try and keep it neat. That's important, double top, double log. So you always know, okay, it's a bit of a trading range here. Then after that, lower low, double bottom, I have another double bottom, which is fantastic at that time. Saying, okay, failed breakout beneath yesterday's low. I have a lower low, double bottom. And remember, we always want to see the pattern, then want to look for the execution. Now I'm just looking for a higher low, whatever, but what I get is a double bottom, another double bottom. Fantastic. So that's good for the bulls. An outside candle, bar by bar, candle by candle. What does that mean to you? An outside candle is a trading range. Okay, so you don't jump in to buy above the trading range. You'll be saying, okay, I get another trading range. Fantastic. That means what I want to see is a breakout above that trading range. I want to see a pullback. And if I get a decent enough signal, I can jump into the trade and see what happens. So there we had trading range. Okay, outside candle, breakout mode. Outside candle, we have an inside pattern here. So that's a breakout mode. Okay. So if the market breaks above that, it's like, let's put it in. Let's put it in. Okay, that's the trading range. That's how precise it's going to be. That's where the market wants to go. If I get a breakout, pullback, I can find ways to jump into the market. But I don't get a bull breakout. If the bulls are strong, why don't they give it? It was a bull breakout, but it ended up as a bear reversal. So there's a problem here with the bull case. So I'm not going to jump into anything, but if I had a decent enough bull candle, doesn't have to be large, even if it's a small candle, even if it's like that happening here, that's good enough. And the follow through and the pullback, which tests the EMA, then I can take the trade, stop here and see how far I go. Okay, the fact that it worked out this way, that's beside the point. Nothing of ours set up here. But now we've got question marks in our minds. There's something wrong with the bull case here. Why are they not giving me successive bull candles when it comes off a reversal? This is in the middle of a trading range. So it doesn't mean the bulls are strong. Middle of a trading range is the market just want to get to the top of the trading range. Okay, so we get to the top of that, where we try to break above that. And the breakout was not successful. Why wasn't it successful? Because this candle should have closed above that high. A follow-through candle for whatever size, I would have said, oh my goodness, the bulls are strong. Let me wait for the pullback to the EMA and trade it. But instead, we end up with a wedge. Remember when you spoke about wedges, 3 attempts, market has tried 3 times to go higher. It's failed, and the market tries 3 times to do something. It's usually going to come back and try and prod and find opposite direction. We then get micro double top separated by 1 or 2 candles at this stage, and you kind of say, okay, now this is good. So all I need now, if I'm back to my bear case, I'm way beneath my 50% pullback. Okay, and we're failing to break above here. But if bears are strong, off this wedge pattern, just give me a couple of strong candles, pull back, and I jump into the trade. But we don't get that, which means we don't jump into it. So bear case, good. They've reversed back into the trading range, but they're not strong, just like we had here. Yes, it's a bull leg in a trading range. It's a bull trend in a trading range. But I am trying to find a nice trade to take. Now I'm in a trading range, but I'm not going to just jump in on the assumption that the market is going to turn my way. Still nothing to trade here. So, you've been hanging around since the opening of the Asian session, and it's end of the session, it's time to go to work. Well, this is one you have to come back and look at and see what's happening. Okay, so bears failed to give a successive break beneath the moving average there after the wedge. So it was still a first leg pullback and a second leg, but nothing for me to jump into. I'm now in the middle of the trading range, and I am waiting still. Okay, I'm not going to just jump in and say, okay, let me take a chance, instead of 60-40, 50-50, if I get stopped out and come again. Quick way to get thrashed in the market. And by the time it sets up, you are down more than the risk you want to allow yourself for the day. Your psychology is messed up. You don't see it. It can just become a horrific day instead of a beautiful day. So we still have the 50% pullback. We see that resumption. We see if the market breaks above that. Well, there's still, there is no measured move that looks like it's going to break above the 50% pullback. So let me see what happens if we break above that. But instead, we end up with another wedge. So we had 3 attempts to break above this price range, failed. Here's 3 more attempts. That's another wedge to break above that. So while I'm not seeing strong bear price action yet, the bulls are not managing to put successive bull candles that allow you to jump in. So the case is still in favor of the bears. Wedge, pullback, wedge, pullback. So at that stage, you're kind of saying, okay, so now we are testing that previous high, again with a wedge. So the market is failing 3 times to break above that. But suddenly, you have this strong bull breakout. Now, if you're a price action trader, and the setup is favoring, in this case, the bears, and you see a wedge forming up, and then the market breaks above the wedge, immediately you gotta be saying, man, with all of this that's formed, I gotta wait and pay close attention, because if it sets up, I gotta jump in, because a break above a wedge is a breakout which may fail. 50-50 chance. If it succeeds, there'll be one candle and follow-through candle. Then say, okay, the bulls are strong. But if it fails, then you got to be prepared to jump into the market. Okay, everything here is setting up pretty nicely for a bear reversal. We don't know yet whether that becomes a trend. We don't know yet. But all we know is now I might have a pattern that allows me to trade back down here. So it's a trading range patterns. A hand raise, I'll look at it, just give it shortly. So you don't know whether it will be a failed breakout, but you're anticipating that if it breaks out, there'll be a follow through, you wait for a pullback. If it fails after that, then you're going to be jumping in with failed breakout above the wedge. That's a double top. That's a very strong level of resistance, strong pattern. You've got to wait just for the close beneath the moving average, jump into the trade with an order beneath that, or the follow through. So I want to see the breakout beneath the moving average. I want to see a follow through, which in this case also closed beneath the 20 EMA. That's where you're going to place your trade, put your stop above here. And your first goal is to get here. So if you're going to go away, put your stop beneath here and let it work. There was a hand raised, but there's no question in the chat box. So if you do have a question, just pop it into the chat box and I will definitely look at it. Okay, so that's trade number one. You have to when it sets up, there's no hesitation. 100% of the times, I'm 60% right. You place your order, you place your stop, and you decide, am I going to be in the market to manage my trade? If not, take profit. If yes, let me wait and see what I get. Not to let me wait and get out of it. Let me wait and see what I get. You got to rely on your stop. That's why I always risk what you have to. Then you reward it with a strong bear breakout, a strong follow through. There's a breakout. I mean, that is a strong bear breakout. At this stage, it is only going to the bottom of the trading range because it can reverse. Okay, it can reverse. Remember, we said 40% of a chance. Trading range, it's reached the bottom. Fantastic. Bulls are saying, well, let me wait and see if I get a double bottom. So take your profits or manage the trade. But there's things to bear in mind here. All the setup that we had beneath the 50% pullback, strong breakout, closing beneath yesterday's low with a follow-through, decent follow-through. Although it's a double bottom, wait and see what you get. Okay, an attempt by the bulls to reverse the test of the breakout point, then another reversal, take that trade. Okay, you got two places to put your stop when you do that. You can put your stop at 50% of the breakout. Remember the 50% of the breakout we spoke about, you can put your stop here. Perfectly fine. Place to put a stop in. If you get stopped out, there's nothing wrong with that. Or if you want to be conservative, you put your stop at the beginning of the breakout. Okay, also legitimate. Nowhere else. Don't just plug anywhere else in. Put it in the correct place. And once you've seen that, guys, what's going through your mind? Well, you're saying I've got a breakout. There's the height of the breakout. Okay, full measure move is here. Or you could just, beginning of the breakout, excuse me, there. And there, depending on what you use, you just tighten where you take your profits from. But you're saying if this breakout is strong, and if the bears we have created, this are the bears that have been creating all of these patterns, and now we've triggered, the sale was triggered for the day. Now there's continuation. Then the market has to create these measured moves 60% of the times. Okay. Just as you're watching the 50% pullback, on the other extreme, you're looking at the full extension of yesterday's range, because now we're breaking below the range of yesterday. The market might want to get to a measured move. So in terms of how you want to manage your profit and take your profits, that's what you start to look at. So you take another trade there. If you're in that trade, you can add on here, build a position. Okay, once you've taken a trade and you see another setup, you must start to build your position. So if you've taken that trade and put your stop here, and you take that trade, that second trade here, then you gotta put your stop here, because you gotta pull. You don't want to double your risk. You gotta pull your stop down to 50% pullback. So the first one is a break even, and you've taken a fresh trade. You're now building a position. You want to wait and see what happens. Now we've had a pullback. Leg one, pullback leg two, that's where it's going to get. So you're saying, okay, I can take optimal profits here, or I can take it at the measure move of the breakout, somewhere within there. If I got to go away, put the take profit in the market. If I'm here to manage it, I'm going to wait and see what happens and see if I can build a position on this. This is looking like it could be a bear trend day at that stage. You don't know yet. It could reverse. But if it's looking like that, if you got your strategy in place, this is a day where you could make decent returns. Remember, the 10 moving average saves us from drawing trend lines, because that indicates the strength of a breakout. So that's the trend line. Okay, as long as the market is holding above that, beneath that in this case, the bear trend is strong. But the 20 EMA, we don't ignore that. Once we start to close above that, then we are into a major trend reversal alert. So there's a trade to take. You have another breakout beneath that. Inside candle, failed attempt by the bears to reverse it. Another inside candle, micro double top. Perfect basic. Take the trade. Take a trade. Let's build the position, because now we've had a break beneath that lower high and a pullback. You can put your stops here. Trade, put your stops here, pull your stops down to there. It's a little bit of a risk here, which means, if you were risking 1% and, you had your stop up here and you pull it down, you can now, half of that or a third of that is now protected. You can put it back in. So you never, go beyond your risk measures. But take the trade. When it sets up, you got to take the trades. When this strategy is set up, that's why we trade less, but we are in the market a lot, because we are waiting to see how these things form. Okay, and that's a game. That's a mind game we have to win. wait and wait and wait at any time frame. Whether in the market or not, it doesn't matter, and sets up to set up on one of the three markets that you trade. So we take that and waiting to see what happens there. So if you want to take all your profits here, do that. But if you are watching the market, don't take your profits there. Why? Because you can see the strength of the bear breakout. Okay, all of this could just be possibly one leg pull back, and then you get another second leg forming. Okay, 10 moving average hasn't been broken, breached. So you can take partial profits, take half of the profits, bank. By now, I mean, you've made a pretty good return at this particular stage. I mean, just on this particular one, 260. So that's almost 300% return on what you've invested here, 3 to 1. Then you add this and you add that. I mean, you're making good return so far. You've waited the whole month, and now it appears, take it. You're going to make more money on this particular trade. And if you don't do anything else and start getting greedy, that can be good reward for you just from that particular day. In any case, one of two options: you've taken all of your profits here, okay, or you've taken partial profits and your stop. Now you've had a breakout, you have a pullback at the profit taken level. You don't initiate anything. You can pull down your stops to just above here, because a little bit of risk. If you're still in the market, you'll bank some profits, but you gotta wait. When you see a break above the 10 moving average, that's fantastic. That particular strong portion of this trend market is broken above that. So there's a lot of profit taken. Some guys have taken profits there. There's a little wedge pattern that kind of formed in this place. Okay, profit taken place, reversal. But there's no bullish strength. If there was strong bull strength, they would have had bull candle, pull back, closing above the moving average. Instead, we get a triangle pattern. Triangle horizontal pattern is a trading range, whichever way you draw it, and if market breaks above that, likely to fail. If it breaks beneath that, likely to fail. So fantastic. We're still in a bear trend, trading range, pull back at the 20 EMA. Fantastic first pullback to the 20 EMA. That's beautiful. I've got to find ways to jump into the trade. Don't worry about the clutter. But if the market breaks above that, that's where it's likely to go. Okay, if market breaks above that little trading range, likely to go there. So I wouldn't be surprised. It might be a double test of that previous lower high. So we're still in the bear market at this stage. This is our first test of the 20 moving average. Tried to break above that, failed. Decent reversal, gotta take a trade. The failed breakout above the trading range. Test of the moving average gap bar. We gotta take that trade. Take the trade, and because we've had that breakout, you can put your stop here and take a trade. Okay, so if you're still holding in with a little bit of profit, even if it only kept a quarter of the profit, keep building the positions. You've banked the money, keep building the positions. We have a breakout by that candle, pull back, again, test of the 20 EMA, gotta put the entry, top of a trading range. Not a perfect one, but we're taking a trade, top of a trading range. You can put your entry here, your stop is still here. Okay, so just a little bit above that. And what are we aiming for? Well, you can always take your profits there if you want, but there's a bear trend that you can't ignore. Okay, the market has failed to break above the 20 EMA and reverse completely. So we are in a major trend reversal alert, but the bias 100% of the time, 60% of the time is towards the bears. But you got to take that trade, right? Okay. Okay, moved along. trying to show the whole view, but I don't want to lose you. Okay, so you take that trade, you can take your profits here, but you get a breakout, follow through, close beneath that. Bears losing momentum. So we're in a trading range. So if you're a bull, you're thinking, which you always got to think the other side. Someone's got to take the other side off. You got to think the other side. Okay, you're a bull, you're thinking, okay, not quite double bottom, lower, double bottom. I have a low there. So it's a bear channel. It's a trading range, but it's a bear channel. It's sloping downwards. So it favors the bears. But if it sets up in a bear channel quite nicely, you can take a trade. So there's my lower, double bottom. I'm thinking bullish and trying to find ways to jump into the trade. I don't see anything here. It's a wedge pullback, failed, macro double bottom. Bears are going to keep jumping in because they say it's a bear channel. But if I'm a bull, I can say, okay, I'm going to jump in there. Lower, double bottom, higher, low. I can take that trade, trading range trade. And all I want to see is if I can get to the top of the trading range. Okay, because that might just be the breakout, pullback, and we carry on. But if you've taken that trade as a bull and the market starts to fail again, remember you are in a bear channel. Okay, that particular trade, when you're taking that trade, that's a bear channel, you're taking that. But you're saying, well, let me see, that might be trading range, pullback, we get to the top here, and might accelerate. But if it fails, now you say, oh my goodness, the bears now have a lower high. They had a lower high here, now they have another lower high. So the channel is still sloping downwards. Okay, there's a whole bear trend. The channel is still sloping downwards. So if you're a bull here and you start to see that, you gotta get out of the trade at break even. Okay, if you kind of wait to see maybe the market may turn at the moving average, that's fantastic. It might turn there. But when you see a bear setup that the bears are going to be jumping in, you can't hold and wish. Okay, get out of the trade. But if my view, when I see a sloping trading range like this in a bear market, I just avoid all bull trades. I don't like to trade bull and bear, which you can, but my psychology can't handle that. I want to stay focused on the bear channel, bear trend, and see if the market can continue to give me a move. Because after the break of the 10 EMA, the potential, that could all be a leg one pullback, which is the whole big trading range, is to get down here. That's the potential for the market. So whether you've taken profits or not, you don't want to be, I don't want to be going long and then quickly changing my mind and say, well, let me go bearish. I can bet you from experience, I will make a little bit of money out of that, but I'll miss out on all of this because now I'm saying, well, are the bulls still are they going to come back? So don't do that. This is a bear trend day. We're well below the low of yesterday, sloping downwards. So take the trade as a bear. Where does your stop go? Well, you got to look at which low do we break. So we're coming from there. We can't put it there. Okay, but we had a lower high here. Market came back, broke beneath from that low, so you can put your stop here. Okay, you would have been stopped out at that particular stage on that particular trade, or you could put it there. So let's assume you put your stop here on this lower high breaking out, and you got stopped out from that bear move because you can stopped out. What do? You don't live, right? 60% chance of success on this day. You wait, forget about it. Been stopped out, push it away, ignore it. Market tries to back above that to get a decent enough reversal. You gotta jump into that trade. You have to jump into that trade. Now that high has been taken out, so you can put your stop above that. And now you want to see if we get to these measured moves here. Remember that measured move we had, extension of the day. That's why we had all these tails. The bulls were trying to stop the range extending beyond the height of yesterday's range. But they failed. Bear breakout, follow through, strong bear breakout. Now we have another leg one, potentially leg two, and a whole new measured move down here. So if you've taken your profits here, what do? You enter in again to the trade, put your stop above here, right? And the whole thing just seems to be repeating itself. Test of the moving average, first attempt. So there's a triangle, breakout mode, try to break out, fail, try to break out, fail, decent enough setup, you've got to jump into the trade. So by now, if you're trading, it's a US session. Jump into the trade, put your stop above the triangle, and just keep working it. Sorry, guys, we have run out of time. I saw a hand, but unfortunately, there was no question to the hand. Guys, I hope you enjoyed it. Just by any quick computation, at the very least on this day, if you worked it, you would have made a minimum of 7-to-1 return on the money you put in. That's 700% return on the day. Thank you very much. Catch up with you guys next week. Guys in the office, sincerely appreciate it. Thank you very much.